Welcome to Intuit's Bookkeeping Certification Program. This program is made up of 4 courses: Bookkeeping Basics, Accounting for Assets, Liabilities and Equity in Accounting, and Financial Statement Analysis. Each course has similar activity types. These include videos, discussion prompts, and practice. In the videos, you'll meet your bookkeeping coach, Bianca. Bianca and her Bookkeeping Rescue show will make an appearance throughout each course. You'll go through bookkeeping topics and situations with Bianca as a guide. The discussion prompts are your opportunity to think about what you've learned and consider what it means for you. Lastly, practice will consist of quizzes and interactive activities where you can self-check what you've learned. Now that you know what's waiting, you're ready to start. Hi there, nice to see you again. Welcome to Course 2, Accounting for Assets. This course assumes you have either completed Bookkeeping Basics or have previous experience in using double-entry accounting to produce financial statements. So if you haven't done that yet, this would be a good time to do so. Don't worry though, I'll be right here when you're ready. In this second course, you'll build on Bookkeeping Basics and dive deeper into accounting for assets. You'll gain an understanding of common asset types, learn how to account for inventory, calculate cost of goods sold, and work with property, plant, and equipment, or PP&E. When you've successfully completed this course, you'll have several new skills to continue building on. Summarize the common types of assets a business may have. Describe the importance of control over inventory. Outline how depreciation expense is reported on an income statement. Illustrate how transactions can be recorded in terms of the resulting change in the elements of the accounting equation. Just like the previous course, you will find that this course is full of interactive content, such as advice from experts, hands-on practice activities, readings, knowledge check, graded quizzes, and peer discussions. The practice you do throughout the course will prepare you to complete a real-world case study that requires you to record increasingly complex transactions and produce financial statements for a small business. That's right, you aren't just learning how to be a bookkeeper, you'll be doing real bookkeeping work. I know you can do it. Here are some tips for success. Allow yourself time and space to focus. Be open to learning new concepts. Come ready to practice and apply new knowledge. Learn from mistakes, and, perhaps most important, have fun expanding your skills. And remember, you don't have to complete everything in one sitting. We recommend that you allow yourself roughly 4 to 6 hours per week to review and complete the course material. Many of the content topics and skills build on one another, so you will have several opportunities to practice important concepts. As with learning any new skill, practice is key to success. Good luck and happy bookkeeping.
Hello again. How was my favorite intern doing? Wait, don't tell me. Like a boss, am I right? I know you are because you look more confident, fancy even, like you just got your hair done or something. Speaking of fancy, do you like the scarf? I'm feeling very France today. Whoever said money can't buy happiness didn't know where to shop. And if you don't like it, well, that's fine. We can't all have the same taste. Anyway, you are radiating boss energy. I love it. Your new skills as a bookkeeper help set Lou straight with his new apartment complex account. And I'm just gonna say it, I'm proud of you. I'm proud of you for putting in the time to learn everything you did about financial statements, the accounting cycle, the accounting equation, and the role of the bookkeeper. You really impressed Lou and me. You kind of remind me of, well, me when I was picking all of this up. Oh, okay, I promised myself I wouldn't get emotional about this. But enough reminiscing. There's good news to share. You did such a great job last season and with Lou that I'm bringing you aboard again as my intern for the next season of Bookkeeper Rescue. That's right. And it's a good thing we've learned so much helping Lou with his shoe boxes, because this next client is going to be a doozy. Well, hop in already. I'll fill you in on the drive over. That's right, we are starting now. Our next situation is a massage therapy business run by 2 sisters. One of them does the books, and the other is the practitioner. Seems like a good partnership, right? But you know how it goes with family business. Not everyone sees eye to eye. And these two place importance on different things in the business. And this probably won't surprise you. They have very different personalities. It seems the practitioner is the creative type, if you know what I mean. She's good at her craft, but her sister is having trouble getting her focused. And the bookkeeper, well, she is ambitious in a different way. I think these two will give us a whole new set of challenges. Let's go see what they're all about. Sophia, you contacted me because you have some concerns about setting up your books for inventory. Tell me about your inventory.
Summer has been making her own massage oil. She has been doing it and perfecting it for years. A lot of customers have been requesting to buy it because they like how it leaves their skin feeling and how it smells. Like a lot. She makes up a few batches and sells it for cash to a few clients, but totally off the books. I think we could really expand the business with this and make a viable product, but I don't know where to start, and Summer isn't helping when she pockets the cash for the bottle she does sell.
I just do my thing, you know? I don't really want to go all commercial. I accept a gift donation for the oil. I mean, I know my sister wants to expand, but I just want to make people feel good. I think we're too small an operation to put any more effort into how we're doing it now.
Summer, honey, if you think you are too small to be effective, you have never been in a dark room with a mosquito. You have a product people want. You can make more people happy by offering it to a much larger base of clients. And you have a business partner who wants to lead this project. All you have to do is to share your recipe and keep making your clients happy the way you are doing now. Are you willing to do that?
Well, I don't know. I'll have to meditate on it and see what my guides tell me. I really don't want to be involved in selling.
You won't have to be involved in any sales. In fact, it will free you up to pay more attention to your clients. But you will need to stop selling your products under the table. We can set up a process that will make it even easier for you. And it will actually allow you to help more people in more ways.
She'll do it.
I don't know, Sophie, and the more you push, the more negative energy you put into all of this. I think you need to go sit in the salt cave a while to neutralize your chakras and get a holistic perspective on what your goals should be here.
I'm not going into the salt cave. Based on observation of actual feedback and real tangible demand, this could take our business to the next level.
I can't even deal with your negativity right now. I won't let it get to me. I am leaving.
Get back here! We need your consent on this deal. My gosh, can you see what I have to deal with every day? There is no getting through to her.
Salt cave?
Is your resume in shape? Do you know what your resume really says about you? Are you making big mistakes on your resume that are costing you the job? What you say on your resume may not be what those who receive it hear. Let's visit some experts on what they are really thinking when they read certain things that some people include on their cover letters and resumes.
My parents think I'm a princess. Blah, 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 blah. Also know how to dress myself.
I haven't changed my email since I was 15. Don't let these kinds of mistakes cost you the job. Get your free resume guide at the link you see on your screen. It'll help you get your resume into shape today and steer you into the job you want.
Are you ready for this? Let's put your skills to use for the next exciting episode of Bookkeeper Rescue.
I was so focused on convincing Summer to sell the massage oils instead of giving them away that I didn't even think about how selling something other than a service is going to impact how we keep the books. This is going to be a lot to manage.
Look, hun, nobody's perfect. Some of us are close, but I digress. You're right. Your bookkeeping is going to have to move to the next level. You'll have some new asset types you've never had to deal with before. Inventory, accounts receivable, not to mention prepaid expenses. Yeah, we've got some work to do, but I got your back. Let's do this. Let's start by going over some common types of assets you'll see as a bookkeeper. Then after that, we can take a deeper dive into the specifics of accounting for each asset type. For example, we'll cover inventory, plant, property, and equipment, non-current assets, contra assets. Okay, I'm getting a little ahead of myself. What can I say? Assets are awesome. Remember, they are anything the business owns and can convert to cash. What's not to love? Nice. I think you've got this asset classification thing down. There's one type of current asset I like to make sure you noticed on the balance sheet: prepaid expenses. Have you ever paid for a yearly subscription to a magazine, media streaming company, or other service because the one-time yearly price was cheaper than paying 12 monthly installments? You know, I love my binge-worthy streaming service. Well, this happens to businesses too. Sometimes it makes financial sense to pay for an entire year's worth of insurance, rent, or a subscription up front. Like, for instance, Sophia and Summer paid rent a year in advance because they got a discount. This amount is booked as a prepaid expense under current assets. Then, as the payment is used up each month, that portion is posted to the appropriate account. For Sophia and Summer's rent example, it would be the rent expense account. I know, this is a lot. We're getting advanced here. Let's have you explore this a bit more on your own, then work through an example.
Now let's talk a little bit about prepaid expenses. So let me give you a scenario. Client is going to be paying rent for the year, $100 a month. And the landlord says, you know what, go ahead and pay me $90 a month and you get a discount. And so great, they're happy to do it. So it's going to be prepaid at the beginning of the year, and they write the check, or they wire the money, or they transfer it whatever way they do. Now, when they do that, there's a clause in their lease that states that if they leave after 6 months, they get refunded the rest of it. So it is not something that is 100% an expense. They really do need to allocate that to each month. And so what we want to do is record that as a prepayment. So as you can see, we have a prepaid expense account right here. This is an account that is set up as an other current asset. It is a detail type of prepaid expense. In fact, let's just open that up and you can take a look at that account and see how it is set up. It's listed as an other current asset. It is a current asset. So that means that it is going to be used within a year. So if it's current, that means it's within the next 12 months. The detail type is that it is a prepaid expense. And of course, that's the same name. This is going to show up on the balance sheet as an asset. So that amount is going to be put into that account. Then what we would do would be to set up a recurring entry to expense out 1/12 of that every single month. So as we go throughout the year, that $90 per month will be recorded onto an expense. So it would debit an expense account, and then it would credit this prepaid expense account. And so after 1 month, that amount is going to be down by $90 and the expense is going to be increased by $90. So the expense account, of course, is on your profit and loss statement, and the prepaid expense account is going to be on your balance sheet. One more little note about prepaid expenses. Sometimes you're going to see this with rent. Very often you might see this with insurance. That's another big one that can come up for clients as well. So there can be several different types. Quite honestly, a lot of small businesses tend to just expense it. So you will see that at some point throughout the year, they're chugging along, things are good, insurance has no money, and then all of a sudden you see that big $700, $800 expense. That is typically a prepaid expense where they have been billed for the annual premium. But if something happened halfway through the year and they canceled that insurance policy, switched to a different provider, you would see that they would get a refund. So when you have something like that, where it is not 100% expensed typically through, and they could typically do it throughout the year, you would want to use an asset account, because in fact, they would want to allocate that. For those of you that want to know, that's something that we call the matching principle. It matches the expense to all of the months that it applies to.
You've officially learned about all the different asset accounts you'll ever need. Oh, wait. Okay, yep, we forgot one. And you know how you finally mastered the fact that accounts increase with a debit and decrease with a credit? Yeah, well, that's great. Again, so proud of you. But with these contra asset accounts, the whole debit credit thing is completely reversed. Crazy, I know. Here's an example. Have you ever heard that a new car loses a big percentage of its value the moment you drive it off the lot? I don't know if that's true, but when a long-term asset like a vehicle loses value over time, we call it depreciation. Fun fact, we'll get even deeper into depreciation as a concept in future lessons. For now, you can focus on it as a contra asset account example.
Accumulated depreciation is used to offset an asset. So let me give you an example. I am going to buy a building, and each year when I buy that building, the value of that building is not immediately expensed at that moment. They do something called depreciate that building. So the building's $100,000. It's going to have a 10-year lifespan. And so we're going to divide the cost of that building and gradually expense it. Then you would create an entry that would take that asset and gradually expense it out. Now, the reason that we might do that is because obviously we are wanting to make sure that we see on the balance sheet what the value of the assets are. And so there's an estimation there of the value of that asset when you look at the original purchase of that building and then the depreciation. After the first year, you would have, say, $10,000 depreciated, and it accumulates. So it's accumulated depreciation is an offset to the asset. So after the second year, it would be, in theory, only worth $80,000. Now, again, we all know that that is just accounting entries that need to be done, but it does kind of give some idea of the usefulness or the value of that asset. From a bookkeeper's perspective, that is not typically something a bookkeeper is going to calculate. It is typically going to be an entry that is given to a bookkeeper to record on a regular basis by the accountant for the bookkeeper to record. It can be set up as a recurring entry every month, or depending on the type of business it is, they may just record it once a year. So it's not a huge impact on the day-to-day processing that needs to happen. And typically, depending on the accounting system, it can be set up and pretty much automated. So there are going to be times when there's other types of contra accounts where we would have an asset value or an account, and then there's an offset to that. Another example could be something like accounts receivable, and we estimate that we're not going to collect 100%. So we might have a contra account to reduce the value of those receivables for something called an allowance for doubtful or bad debts, doubtful accounts or bad debts. It's basically saying out of $100,000 in receivables, we're estimating that we won't collect 5%. And so we're going to record an allowance, an estimate of what we won't collect, so that it's a little truer. So especially if you're looking at a bank or an investor and they want to have a good idea of what the assets are, and we can estimate what that would be. So we would show $95,000 as total receivables. So that type of entry could happen. Again, typically those types of transactions or entries are going to be created by an accountant, and the bookkeeper would record those. And so that's how that would happen. Not a ton of accounts are like that, but there are just a few, and it really just helps us to have a better understanding of the value of the assets and other accounts that are there.
Okay, sweet. I'm liking this asset stuff. More assets, more money, right?
Maybe. Assuming you know how to keep track of sales. So, Summer, as you know, we've been observing the checkout station of your business on camera.
Yeah.
Well, I noticed a few clients leaving with massage oil, but those sales weren't recorded. So what gives?
Look, I know this is business, but it's also my calling, you know? Like, I was born to help people heal. Sometimes my clients don't have enough money to buy the oil, so they pay me half in cash. I donate the cash they give me to the food pantry. It all balances out.
What doesn't balance out is your books. Look, honey, I love how big your heart is, but you have to buy products to make the oils, right? And that money comes from the business. You need receipts and things like that to keep track of everything. If you start losing money and possibly the business, who can help you then?
Okay, I'll find another way to gift oil to customers who can't afford it, so it won't impact the business. I won't sell it in secret anymore.
Good choice. Okay, now let's get ourselves together and figure out what we need to do next, okay?
Sounds like a plan.
Now that Summer is going to make sure she only sells oils to paying customers, we need to figure out how to post sales in the books. When you make a sale, the customer can pay you right then with cash, check, or credit and/or debit card. This is often referred to as a cash sale. Or you might agree that they can pay you later and send an invoice. First, we'll look at scenario 1, a cash sale, where the customer pays today. Recording a cash sale can be done in one of 3 ways. 1. Manually create a journal entry. 2. Using accounting software. Or 3. Through a point of sale, POS system. We'll take a closer look at each one next. We covered how to manually enter cash transactions without software in an earlier lesson, and you practiced it quite a bit. So, I brought a friend along to give you the behind-the-scenes scoop for this whole cash sales process.
Cash sales obviously don't affect accounts receivable. You are bringing money in at the time of sale. So sometimes people get confused with the word cash, meaning it must be, bills, cash, but that's not necessarily the case. What we mean is a kind of a cash basis, meaning somebody came in, they purchased that cup of coffee, they paid for it with a credit card or a debit card or cash, and that money is immediate. Usually it's funded in the bank within a day or two, and so it's immediately showing as income at the moment of sale, and it's showing as a deposit in transit about to go to the bank immediately. So assets are being increased and income is being increased as well, affecting both the balance sheet and the profit and loss statement. Cash sale, which is immediate cash coming into the company, would affect both the balance sheet and the profit and loss statement, and also the statement of cash flows. But let's stick with the profit and loss and the balance sheet. As soon as that sale is recorded on the profit and loss statement, you're going to show an income on the income section of the profit and loss. And that would have been a credit if you were going to do this with a journal entry. So the credit column would have the income amount, and then the other entry on that journal entry would be to cash. So basically the money is going straight to the bank. So debit the bank, credit income. So immediate money.
A quick word about sales receipts. I know you're wondering, what the heck? We were just talking about cash sales, crazy lady. Trust me, it'll all make sense. So anyway, we all get sales receipts as customers. But did you know they're used for accounting too? You remembered that a copy of the receipt is kept for accounting purposes and can be used to enter information manually? Now remember that receipt info. We're gonna need it soon. As you know, most businesses use accounting software to record transactions. You can manually input sales receipts using accounting software, or sync your software to a point-of-sale (POS) system that captures the information for you. Let's start with seeing how to enter sales transactions into accounting software.
Let's go over how to create a sales receipt in QuickBooks. We'll also show you how to use the undeposited funds account, so you can group transactions together into a single deposit to match your bank records. Note that if a customer pays for their purchase right away, you record a sales receipt. But if they're going to pay you later, then you create an invoice. We'll go over that in a separate video. To start, go to the New menu and select Sales Receipt. Customer information is optional on a sales receipt, but if you want to track your sales by customer, you should enter it. The date of the sale defaults to today, but you can change it if the sale happened on another day. For payment method, choose how your customer paid you. If you want to add a new payment type, you can select Add New. If you want to process a credit card payment using QuickBooks Payments, check out our link at the end of the video. For this example, we'll select cash, but if we got paid with a check, we can record the check number. Next, tell QuickBooks where you're going to deposit the money. For this example, we'll select Undeposited Funds. Undeposited funds is a temporary account that holds payments you plan to deposit later at the bank. It lets you easily combine several payments together into a single bank deposit. However, if you're going to deposit this payment into the bank as a single transaction, then you can skip this and just select Checking. Next, in the Products and Services area, enter what you sold your customer. If you already set up the product in QuickBooks, you'll see the description and amount you entered earlier. You can also enter or change these while you create the receipt. If you haven't entered this item yet, select Add New and enter it here. Choose everything that's included in this sale. Once you're done, select Save and Send if you want to send the customer a receipt, or one of the other save options if you don't. You'll see your customer's receipt here. You can change the subject line and the body of the email that gets sent to your customer. Select Send and Close when you're ready to send the receipt. Now you're ready to create your own sales receipt.
Hey, did you know you can manually enter sales receipts with software daily, weekly, monthly, or quarterly, depending on the processes of the business? In some cases, you will enter every sale separately. In other cases, you might enter the total daily sales as a summary of all the sales made that day. Just remember, the frequency of your posting impacts the type of financial reports you can run. You'll want to provide the level of detail that helps the business owner make the best financial decisions. That's why we're here. On to my favorite topic. Well, who am I kidding? I could never pick just one. Anyway, on to credit sales and what some people refer to as invoicing. An invoice is when you give customers time to pay for your goods or services.
Let's go over how to create an invoice. We'll show you how to add customers, products, and services to an invoice, and then how to save and send them. Let's start by looking at the customers list. Select Sales and select Customers. The customers list keeps track of who you sell things to and provide services for. It also gives you the current balance for each of your customers. Use it to see what customers owe you, or sometimes what you owe them. Let's create an invoice for an existing customer. Go to New and select Invoice. The first thing is to record the customer's name. Notice that QuickBooks populates both the billing address and the email address for this customer. That's because this info was already in the customers list. However, if you need to add a new customer, you can do so by selecting Add New. If you want to send an invoice to more than one address, use a comma between each one. You can CC or BCC an address too. QuickBooks also lets you add a Pay Now button to the invoice. That way customers can pay with a credit or debit card or a bank transfer. The date should be the day you send the invoice, or if this transaction happened in the past, the date you issued the invoice. Terms set the number of days a customer has to pay the invoice. You can add other things too. Go to the gear icon to add things like shipping and custom fields. In the Products and Services area, enter what you're charging the customer for. If you don't find a product or service that looks right, select Add New to create a new one. If you set up the product or service ahead of time, you'll see the sales description and price you entered earlier. You can also enter or change these while you create the invoice. Add as many products and services as you want. There are more options further down the form. You can enter a message to include on the invoice. You can also add a statement memo. The statement memo shows up as a note on your customer's statement if you send them. You have several options for saving invoices. You can save the invoice and keep working on it. You can save anew if you want to save the invoice and create another one. You can save and close, which saves the invoice and brings you back to whatever you were doing before. You can save and share a link. Save and Send lets you write an email to your customer and will attach the invoice to the email. Let's select Save and Send. On the left, you can see and change the subject and body of the email you're sending, and on the right, you see a preview of what your customer will receive. Select Send and Close to send the invoice. QuickBooks confirms that the email was sent to your customer, and you can see the customer's balance has increased by the amount of the invoice. Now you're ready to create your own invoices.
We've really got this whole accounting for sales thing down. Unless someone doesn't pay us.
Well, I'm sure people wouldn't want any bad karma for not paying.
Ladies, what's with all of the yelling? Why are you two arguing?
My brilliant sister here decided to lend her friend Moonbeam some money from our business account.
His name is Michael, and it was just a loan so that he could buy some equipment for his interpretive dance studio. He's going to pay us back. And anyway, it's good karma.
Yeah? Well, karma doesn't pay our bills. I really hope you got everything in writing.
Sheesh, these two are something else. You know, running a successful business isn't all just tracking sales and expenses. Sometimes it's providing business loans and offering customers credit. As a bookkeeper, it's up to you to keep track of all that money moving around and, if necessary, writing off money that can't be collected. In general, this is pretty straightforward, but you will be working with some new account types, so buckle up. Let's get started. Now, I don't have to tell you how important it is to track every penny. One way to do this is by using promissory notes. Businesses use these notes for a couple of reasons. For example, like Summer, maybe a business loaned money to another business. Or maybe a customer or vendor is overdue on a payment and now are agreeing to a payment plan with interest. Regardless of the reason, promissory notes are essentially contracts that need to be accounted for on the balance sheet. Let's hear from an expert with some advice about working with promissory notes.
So a promissory note is basically a loan. A couple of things you need to look at when it comes to a loan. It's going to be a liability on the balance sheet. So that's the first place you're going to add an account. The question is it going to be a short-term liability, which usually means it's paid off within a year or so? Long terms would be longer than that, more than a year. Maybe it's a mortgage or a car payment, something like that. So it's a long-term note, and you need to make sure that you choose the right type of account so that it is reported in the proper area on the balance sheet, short-term or long-term. Things to look at when you're looking at that actual loan document, there might be a certain amount of that, the fees for processing the loan might be something that gets written off. There's the loan balance. And so you need to kind of check out what can be put as a debit on the profit and loss as a business expense. There might be processing fees or something like that. But basically, the entire balance that is going to be paid off should be listed as a note payable somewhere up on the balance sheet, either long-term or short-term liability.
When a promissory note is issued, you'll use either the notes receivable or notes payable accounts. These accounts function a lot like accounts receivable and accounts payable. However, notes payable and notes receivable are a bit more formal and usually incorporate interest payments. From a bookkeeper's perspective, notes receivable is money that is owed to a business, so it is considered an asset. On the other hand, notes payable is money that a business owes, so it's a liability. I know this is a new concept, so let's hear from an expert with a bit more info.
With the words being payable and receivable, you could possibly consider accounts payable and accounts receivable, and they're not the same. So I just want to kind of point that difference. So accounts payable and receivable are for something as service from a vendor that you pay on a monthly basis. Notes payable and receivable are more of a written agreement. So it's more like I have an auto loan that I pay on. So it would be more like that for a notes payable. And notes receivable is the same way. It's a written agreement that you have with a client. So accounts payable, is more month to month. And you could think notes payable is as well, but it's a written agreement. That's the biggest difference. It's an agreement that you're signing and you're agreeing to.
Now on to journal entries. These are a little different, so let me show you an example. Take Summer and her friend Moonbeam. If she loaned him $10,000 at a 10% compounded annual interest rate to be paid back in 2 months, we would create an initial journal entry like this. The next month, Summer gets her first payment. Now, to create this journal entry, we first need to figure out what the interest was on the payment. To do that, all you need to do is use this formula. In this case, the interest was $82.19. So we would debit our cash account $5,082.19, credit the notes receivable account $5,000, and credit the interest account $82.19. When Moonbeam sends his next payment, just follow the same steps and fill out a new journal entry, which will show that his loan is paid in full. Now, you might be asking yourself why the interest amount is different in this journal entry. You're a quick one, aren't you? Well, when the first payment came in, it reduced the amount that was owed. Interest is only charged on money that is still owed, not what has been paid. Summer likes to think the best of people and assumes they will pay her back. But reality can sometimes be a splash of cold water. Because of that, we have accounts uncollectible and a process for recognizing money that won't come in. When a customer or vendor pays for something on credit, that amount is logged under accounts receivable. Over time, 30 days for example, if the customer fails to pay, this money moves to an aged receivable account. Then, if even more time passes with no payment, the money moves to a doubtful account, and then finally, an accounts uncollectible. This is logged as a bad debt expense on the income statement, and of course will reduce your profits. Let's say Summer and Sophia sold $5,000 worth of massage oils to many customers. Of that $5,000 in sales, $1,000 was sold on credit to the store Nature's Bounty. Nature's Bounty declares bankruptcy, and it is uncertain if they will be able to pay the $1,000. Summer and Sophia show $5,000 in accounts receivable, but now also $1,000 in allowance for doubtful accounts, which would be $4,000 in net accounts receivable. Over time, it's determined that Nature's Bounty had creditors in line and received all assets as priority lenders. Because of this, Summer and Sophia will not be receiving the $1,000. Summer and Sophia now have to write off the amount as a bad debt expense on their income statement and reduce the allowance for doubtful accounts by $1,000. Got it? Good. Just in case, though, here's an expert with some advice.
One thing that if you find that you have uncollectible accounts, then you might figure out that you've got to, as a business owner, you might figure out that you've got to be more proactive and perhaps even aggressive in getting your money, because the longer it takes for somebody to pay you, as time goes on, the odds that they're going to pay you drop and drop and drop. So it might allow the business to say, hey, we've had a lot of bad debts from these uncollectible accounts. Let's either raise our prices, or if it's clients of a certain type, we'll ask for money up front, or we're going to change our terms or something like that. So when you've got that going with uncollectible accounts, yes, it's definitely a hit to the bottom line, but that means that the business decision makers have to pivot and not continue doing what they were doing. What do new bookkeepers need to know about working with uncollectible accounts? Well, certainly they need to know how to book those uncollectible accounts so that they no longer appear in accounts receivable. So they have to know how to write off or write down these invoices, whether they're going to use the accountant tools with the write off invoices tool, or if they're going to create a credit memo for either to bad debt or to the original revenue accounts. And if there's any sales taxes involved, then they should definitely use the credit memo approach, because that way you can include the sales taxes. So if you thought you were collecting $50 in for sales taxes, you don't want to have to remit that to the various governmental bodies if you're not actually getting that from your clients. So you want to recoup that by doing a credit memo to bad debt or to whatever revenue, and make sure that you hit the same sales tax codes so that it reduces the sales tax that you owe to those governing bodies.
I realize I just threw a new term at you, bad debt. My apologies. In simple terms, when you extend credit to customers in your business, there is a chance they might not pay that money back. That possible loss of money is what we call bad debt. It's just the risk that you take. From a bookkeeping standpoint, there are two ways to write off bad debt: the direct write-off method and the allowance method. The direct write-off method is the most straightforward and is used mostly by small businesses. However, there are some issues with it. The more accurate and appropriate method is the allowance method. This one takes a little more thought, but is better in the long run. I know this is a lot to take in, so let's hear from an expert with some advice about working with bad debt.
So occasionally when you're looking at a financial statement with your client, you might find accounts receivable is really not ticking down very fast, and you look through the actual open invoices with them, and you would go through that and actually ask them, is this collectible? Are you really going to be able to get this from Bob, who's owed you this for 5 years? So in some cases, the client may want to write this off as bad debt. It may not necessarily be the bookkeeper's decision to write things off as bad debt, but you should know about it, because when it does come up or you do detect that there are some uncollectible receivables there, that it's time to write them off. And so you'll be probably given instruction or permission from the owner to go ahead and do that. One thing you should consider is if it is a invoice from 5 years ago, you really don't want to go in and void the invoice, because what you would be doing is actually changing transactions from a prior period. So what you need to do is record bad debt. There's several ways to do it in accounting programs like QuickBooks Online, but for general purposes, we need to reduce income and then write it off in accounts receivable, so it doesn't show that invoice is open any longer. So you could do a credit memo in QuickBooks Online and pull the item that was sold 5 years ago and reverse that. A credit memo could be applied to an open invoice and wipe that out. And you could also do a journal entry, which also represents that same thing. So we're going to debit income and credit accounts receivable and apply that payment against the open invoice to wipe it out. Again, bad debt is just something you need to be looking at when there are uncollectible items sitting there on the balance sheet, and it's just time to clean up the books. So periodically when I'm working with a client and we are reviewing their financial statements, I definitely open a report in QuickBooks Online that is the unpaid invoices report. And we go through that and look at it. And in some cases, this is usually with a new client because stuff just gets ignored and they're the client that's reached out that needs help. And so I'll look through things like that, unpaid invoices. And if I see things that are a year or two old or even older, I will have that conversation and say, what is all this? Did you actually collect it? It could be they did and they just didn't apply the payment properly. Or maybe it's just an older client that never paid their old bill, and that would be considered bad debt. So in that case, I would have the conversation pretty much invoice by invoice, customer by customer, go through their report, and then in some cases, I'll just email them the report or put it on Excel and have them fill in exactly what they want me to do with each line item, and then I'll go ahead and adjust it. Some might be bad debt, and some might be, hey, I got paid, but I don't know why this is still open. So I can fix it for them. So you just have to have the conversation with the client and review their existing records.
Hey, look, Summer. Your friend Moon, Michael, sent us his first payment for that loan you gave him.
I told you he was good for the money. He has a blue aura. It's a very loyal color.
Sure. I'll take your word for it. I'm just glad he didn't skip town.
And I'm just glad Summer got a promissory note in writing.
Okay, but promise me, Summer, no more surprises. All right? Summer?
Hi there, nice to see you again. Welcome to Course 2, Accounting for Assets. This course assumes you have either completed bookkeeping basics or have previous experience in using double entry accounting to produce financial statements. So if you haven't done that yet, this would be a good time to do so. Don't worry though, I'll be right here when you're ready. In this second course, you'll build on bookkeeping basics and dive deeper into accounting for assets. You'll gain an understanding of common asset types, learn how to account for inventory, calculate cost of goods sold, and work with property, plant, and equipment, or PP&E. When you've successfully completed this course, you'll have several new skills to continue building on. Summarize the common types of assets a business may have. Describe the importance of control over inventory. Outline how depreciation expense is reported on an income statement. Illustrate how transactions can be recorded in terms of the resulting change in the elements of the accounting equation. Just like the previous course, you will find that this course is full of interactive content, such as advice from experts, hands-on practice activities, readings, knowledge check, graded quizzes, and peer discussions. The practice you do throughout the course will prepare you to complete a real-world case study that requires you to record increasingly complex transactions and produce financial statements for a small business. That's right, you aren't just learning how to be a bookkeeper, you'll be doing real bookkeeping work. I know you can do it. Here are some tips for success. Allow yourself time and space to focus. Be open to learning new concepts. Come ready to practice and apply new knowledge. Learn from mistakes, and, perhaps most important, have fun expanding your skills. And remember, you don't have to complete everything in one sitting. We recommend that you allow yourself roughly 4 to 6 hours per week to review and complete the course material. Many of the content topics and skills build on one another, so you will have several opportunities to practice important concepts. As with learning any new skill, practice is key to success. Good luck and happy bookkeeping.
Check it out. My salt lamps arrived today.
Wait, what?
I'm sorry, your what now?
The salt lamps I ordered came in. They help boost positive energies.
I thought we were going to order more furniture for the waiting room. Are clients supposed to sit on these now?
No, but a lot of clients have been asking about them. They're so beneficial, I thought we could have a few on hand. There. The air feels cleaner already, doesn't it?
You are not allowed to buy anything else.
So, how many of these did you buy, sweetheart?
Just a couple. They were only $15. If they don't sell, I'm sure we can use them around the studio.
Well, I wasn't planning on going over this just yet, but it looks like we're going to need the crash course on inventory. Inventory is a significant asset on a company's balance sheet and needs to be monitored very closely for events such as what has just transpired before our very eyes. You see, too much inventory is, well, too much. And for salt lamps, far too much. It can result in additional unforeseen expenses and maybe even losses. Now, too little inventory, and you run the risk of creating very unhappy customers who just might decide to go somewhere else. So, let's jump into it and talk more about inventory, so I don't have to hear any more yelling from those two. Yeesh, salt lamps. So, inventory is the stuff that a business buys and holds with the intent to sell to customers. With a merchandising business, that's about the long and short of it. Holding goods with the intent to sell them to customers, all to earn revenue. With a manufacturing business, it's a little more complicated because they take raw materials and fashion them into the products that they then sell to customers. Now, of course, there's the businesses, like the dance studio right next to Eternal Summer, that don't have to deal with any of this inventory business. Our friends Sophie and Summer have just dipped their toes into the inventory ocean, however, so we'll have to help them log their salt lamps into the... Oh my, she just sold one already. Why don't you listen to one of our experts share more about inventory while I congratulate them?
It can be really simple. There's a client that I have. They sell auto parts. So they purchase the auto parts. They have their inventory in their warehouse, and their warehouse is huge. So when they started, it was not that large, right? So they started very simple, but here's the thing. When they started entering the inventory however they wanted to. There was no specific organization to it. So when you are starting out doing inventory, there really has to be thought to how you want to structure that. It could have been structured as based on the car model, but they did all by whatever the company they were purchasing it from was how they would enter it in. So based on that, you're going to have a lot of different thoughts on that. So in the inventory, there's no clear organization, there's no structure to it. And so you have to really think about that. Will I put it as based in this specific situation? Will I put it based on what year the car was and then the model? Will I put it based on the model and then the year? And so you really have to structure that in a logical way so that when you're training somebody else, you really have to think about that, right? Like when you're training somebody else, how is it going to be easy to explain how to find something? If you don't have a way to look for something, you can do a search on it and try to find it that way. But if you have an inventory structure of how to label things, it really makes things a lot easier.
For the first time in my life, I'm speechless. Still not sure why you'd buy a salt lamp, but I'm glad they've got one sold. Let's see what that transaction might look like on the books. Our first journal entry should reflect the transaction that occurred when Summer purchased the lamps. Recall that she bought 4 lamps at $15 each. That would put the cost for her to acquire the 4 lamps at $60. Okay, so we got that out of the way. Let's look at our journal entry to record the purchase. Summer paid cash for the lamps, so you would debit the inventory account and then credit the cash account, like this. Summer was able to sell her first lamp for $30. We will record this using 2 journal entries. The first entry will help us recognize our revenue. The customer paid with a credit card, so we'll have to debit cash and then credit the revenue account like this. In this second journal entry, we'll need to credit the inventory account and then debit our cost of goods sold account, like this. If we were to take a small snapshot of the income statement at this point, it would show us a profit of $15. Woohoo! Way to go, Summer! Now, those journal entries represent the transaction of just one salt lamp. But how would Summer and Sophia account for many at one time? For that, they'll need to set up an inventory system. There are basically 2. perpetual and periodic. Remember our basic definition of inventory? The stuff held by a business with the intent to sell it to earn revenue. With a perpetual inventory system, the inventory account is continuously or perpetually updated to account for inventory as stuff is bought and sold. On the other hand, a periodic system updates the inventory account only at regular intervals, such as at the end of an accounting period. Perpetual systems are pretty handy because they help you track your inventory in almost real time, which means you can see things like where your inventory levels are at. On the other hand, a perpetual system could be more costly to set up for a small business like Summer and Sophia's. A periodic system is much simpler, which makes it less of a hassle to set up. With a periodic system, however, you lose that real-time view of your inventory since you are only checking it at specified intervals. This makes it much more difficult to know what's going on in between your inventory counts. Let's hear more about these systems from our experts.
We're going to talk a little bit about perpetual versus periodic inventory. Now, inventory, of course, is when a business owns assets that it is going to sell and earn revenue from. And the question here is, when do the costs of that asset get recorded against those sales? So a perpetual inventory is when a sale happens and the cost of that item, the amount that's in the inventory asset account, is immediately expensed as what we call cost of goods sold. When you are doing a periodic system of inventory, then it happens on a frequent, regular basis, but not necessarily or not at all at the time that the actual sale takes place. So depending on the type of company it is and the amount of inventory and sales that they have, the smaller the organization, the more likely they are to be using a periodic inventory calculation where they do it quarterly or in some cases even just annually, where they determine how much inventory they've produced minus how much they have left at the end of the year, would tell them what their sales are, and that amount there would be your cost of goods sold there, the difference between your beginning and your ending inventory, and your purchases, of course. So with a perpetual system, there is typically going to be an automated inventory system that is going to calculate that for the client, allowing them to have the sale and the cost of sale booked immediately all throughout the year. Now, a perpetual inventory system will still do an inventory count at some point, but typically on a frequent basis, they would adjust that inventory based on any type of what they call inventory shrinkage that could happen where something gets damaged or destroyed or lost or whatever the case might be. But the ongoing regular maintenance of that costing is happening on a perpetual system is what typically would happen.
Let's go back to Sophia and Summer as an example. They've been busy selling their salt lamps. They started the month with 3 in their opening inventory. Take a look at the table to see how we would track their inventory under a perpetual system. Each time inventory is purchased, we add to the total. And each time we sell some inventory, we would subtract it. Let's use the following inventory calculation to work out the cost of goods sold in our example. They purchased their lamps for $15. In this example, we assume that all of the inventory was bought at the same price. In the real world, however, it's common to expect those costs to go up or down. For that, we'll have to make some inventory cost flow assumptions. So, in our previous perpetual example, try to say that fast 3 times, the cost for Summer to purchase her salt lamps stayed the same. Let me tell you though, that's not going to happen in the real world. In the real world, costs change. When we're accounting for the flow of inventory through the business, we also have to account for the flow of these costs as well. To do that, we need what are called cost flow assumptions. The assumptions are like guidelines that we use to help us estimate what the flow of cost through our inventory might be. There are basically 3 main assumptions. 1. FIFO, which stands for first in, first out. 2. LIFO, which stands for last in, first out. And 3. Average cost. So what assumptions are these cost flows making? In FIFO, we are making the assumption that as we make sales, we will continually sell off the oldest inventory first. First in, first out. In LIFO, we are making the opposite assumption, last in, first out. With average cost, we are making the assumption that all the items in our inventory are all priced at their average cost. We're going to take a look at an example using the FIFO method. But first, let's have you listen to one of our experts discuss these assumptions in a bit more detail.
There are 3 different methods of inventory costing or valuations. The 3 that we'll talk about are FIFO, LIFO, and AVCO. So we have LIFO, last in, first out. We have FIFO, first in, first out, and we have average costing. So what are the different methods? Well, LIFO, last in, first out. So if I receive in 100 widgets and then I receive in 90 widgets, last in, first out, those 90 widgets would be the ones that are costed out first. So the last ones that came in are the first ones that are costed out. First in, first out, using that same scenario where you received in 100 and then you received in 90, first in, the first 100 would be the ones that are costed out first. So when we sell one of those costs of the first 100 would be used. Average costing would take all 100 plus 90, 190, average all those costs together, and that's how it would be costed. So why would a small business decide one method over another method? Well, sometimes they just find it easier. Quite honestly, most of the time, they probably would just use average costing because, again, it's easier calculations. However, their industry may decide for them which one they should be using, last in, first out, or average costing. So it also can depend on the type of inventory they maintain. So if they're maintaining perishable goods, then they may want to do FIFO so that those items are costed out first. So the most recent are left in inventory. There can also be some major fluctuations in the value of the inventory. So they might buy those first 100 at $1 a piece, but then the last 90, they pay $10 a piece. There's a great variation there. So we want to make sure that we're accounting for those properly. And again, depends on the industry and several different factors. So it can get kind of complicated depending on the client and their industry and their needs. But those are the 3 different costing methods and how they might start deciding which one of those to use. One last note about costing methods. If a client decides to change costing methods of their inventory, that is definitely something that has to be considered because there are forms that have to be filed with the government to alert of that change because of tax implication changes.
All right, kids, down to the nitty-gritty. Remember, when you make a sale, you're not just earning revenue, you're also incurring a cost. Our handy cost flow assumptions help us estimate what these costs should be. Now, with FIFO, we're assuming that our inventory is flowing from first in, first out. So let's go back to Summer and Sophia as an example. In our previous example, we just assumed that the cost of the lamps didn't change. But what if it did? Let's review our example. We said that they ended this month with today being the only salt lamp sale they make. We also said that in the next month, they purchased another 6 salt lamps, again for $15, but then sold 5 lamps. This time, let's change the price of Summer's additional purchase and say that she bought 6 lamps for $18. How will we calculate our ending inventory now? If we refer back to our handy inventory calculation and plug in what we know, we get this. We know what our opening inventory and additions are, and we know that we sold 5 salt lamps. We'll start with goods available for sale, 3 lamps from last month, and an additional 6 added together gives us 9 lamps with a total cost of $153. We'll now work out the total cost of goods sold. And here's where the FIFO comes in. We know we sold 5 units, but how does that break down? With FIFO, we can assume that the 3 lamps in our opening inventory will sell first for a total of $45. To reach 5 lamps sold, we will then need to sell 2 more lamps from the additions purchase for $36. $45 plus $36 is $81. $81 is our total cost of goods sold. To work out our closing inventory, we just need to subtract our cost of goods sold from our cost of goods available for sale. So at the end of our example month, Sophia and Summer would have 4 lamps with a total cost of $72. Now that's a job well done, ladies.
You know, Summer, after that whole incident with Moonbeam, I wasn't thrilled with this whole salt lamp idea.
I'm sorry I didn't tell you about it, sis, but my guides were really speaking to me.
Oh, look at you two. Makes me so proud. I'm getting all choked up.
Well, I'm glad you listened. I really think we could sell these. We could sell even more if we put them on our website.
That's a great idea.
Just promise me that from now on, you'll tell me first, okay?
Yeah, about that, I got something I need to tell you, sis.
Summer!
Hey, there you are. You know, the girls have been pretty successful selling these salt lamps, much to my surprise. I really didn't know they were a thing. But I also didn't know that the division symbol is a blank fraction with the dots replacing the numerator and denominator. Crazy, right? Stick with me, kid. You'll learn something new every day. But you knew that already. Well, let's see how our friends are doing tracking their inventory. And if they sold some more salt lamps. Hi, ladies. What's all this?
Oh, we got another delivery. These are my oils. You know, the ones I use to make my special blends with. But now a big batch of them, and with a few different varieties.
Yeah, this was Summer's surprise. I mean, I guess it makes sense because there is a big demand. I will get started on making new entries in the inventory management software, just like I did with the salt lamps.
Whoa, not so fast, cowgirl. These here are raw materials, not finished goods. They are not handled the same way as straight inventory.
Huh?
Uh-oh.
Yes, there is an extra step with raw materials. But don't worry, it's not so complicated. I'm going to explain it all to you right now. The ladies were sure worried back there, but this is going to be a piece of cake. Speaking of cake, vanilla cake is my favorite with chocolate frosting, but I digress. We are going to present the ladies with a couple of costing method options for the oils and how to record raw material inventory. Let's just get right into it. Summer bought a bunch of different oils in bulk. These are the oils she mixes together using her own recipe to make a final product. But the purchased oils are raw materials. She won't resell them. All of the products a company sells or can convert into something it sells are its inventory. Inventory can be an item the business purchased and is reselling, raw materials, or finished goods. Finished goods generally start as raw materials, then move to work in process, then move to finished goods. But Summer and Sophia don't have much manufacturing going on. They really only have the raw materials and finished goods to keep track of because, let's face it, the process to make the final product is pretty simple. Let's hear from an expert on what this looks like when there is a work-in-process component, usually in a manufacturing setting.
An overview of raw materials, work in progress, and finished goods in a manufacturing setting. So if a client company has inventory on their balance sheet and they're tracking it and they do manufacturing, they probably are not using QuickBooks by itself because QuickBooks Online is not meant for an inventory assembly or manufacturing process. So, but if they need to track, or if they're doing it manually, they could be tracking inventory manually or in Excel and then just entering summary transactions in QuickBooks. That could happen as well. Just know that if you have your raw materials widgets and they want to keep track of raw materials different from work in progress, which is different from the finished goods, then you are going to have to be very careful to make entries quite often, whether it's daily, weekly, or monthly, to move inventory items along and move them from their finished goods account. You might have to do inventory adjustments to take them out of out of raw materials, and then make another, and another part of that same entry is to add work in progress inventory to the work in progress, or add numbers or figures to the work in progress inventory on the balance sheet. And then as that gets worked on, maybe later on there's going to have to be another inventory adjustment to move numbers out of the work in progress inventory or work in process inventory, and add products or services and numbers of those or products to the finished goods area. So it's going to require a lot of meticulous record keeping, even in QuickBooks, because if the client wants to know how much raw materials, how much work in process, how much finished goods they have, you're going to have to make those entries, probably inventory adjustments, to move items from one phase of the raw phase to the work in process phase to the finished goods phase.
Ooh, look at you. Now, once Summer has created her final product, it becomes finished goods and is ready to sell. Oh, a text from Summer. Guess what? She just sold her first blend. Let's go visit the ladies and see how they're handling it.
So how do we record this now?
Well, now, it's recorded as cost of goods sold.
That's not so difficult.
A piece of cake. In fact, I think it's time for a piece of cake to celebrate this first legitimate sale. Meanwhile, I'm going to turn it over to an expert who can walk you through the journal entries that will happen. Take it away, my friend.
Some companies choose not to track inventory product by product inside their accounting. So occasionally there's an inventory count and you adjust inventory according to the value that is left. So maybe at the end of each quarter, someone will go into a physical count, figure out the value of that inventory, and then you do a journal entry to adjust the value of that asset. So I'm going to go ahead and make an adjustment to inventory. Let me type in inventory asset, which is a current asset on this company's books. And we're going to go ahead and say they have an increase in inventory between the last inventory count and now. So let's say that value has increased by $15,000. And I'll just type adjust to physical count. Okay. By the way, I might want to attach that physical count worksheet to this journal entry, which you can in QuickBooks Online. I'll show you where that is in a second. And then I'm going to adjust that against cost of goods sold. And you can see it's already pre-populated the debit side of that, adjusted to physical count. Obviously, you want the date correct. Let's say that physical count was done on March 31st. And then down at the bottom here, there is a way to attach documents. So if you do have that physical inventory count that maybe somebody went around the warehouse and wrote it all down and signed off on it, and you determine what the value of that inventory was, you've got an attachment right here. You just click through and you can browse to that. So that's kind of cool. All right, and that is how to adjust cost of goods sold with an inventory adjustment.
Hey, Sophie, I think I'm going to create some other blends. Oh, and maybe some candles. I'm really into this high volume creation.
You really make my head hurt, Summer. You can't just make things willy-nilly. You have to consider the impact on inventory and managing everything. Have you learned nothing?
That's your job, sis.
Bianca.
Oh boy, here we go again. I have talked a lot about inventory and some of the different costing methods, but inventory errors are another part of your life as a bookkeeper. When it comes to inventory errors, there are two ways that you can look at it. From a business owner standpoint, inventory is a big investment. That's why inventory management and tracking turnover is so important. Companies want to make sure they aren't buying too much inventory, losing it, or misplacing it. Wow, Summer. People are really loving your massage oils. These things are flying off the shelves.
I know. I never would have guessed that they would be this popular. I can barely keep up. But it just goes to show you, when you put good vibes into the world, karma will pay you back.
Well, and it helps to have a fantastic, beautiful bookkeeping expert to help get your books in order.
Oh yeah, that too.
Speaking of that, Summer, how are we doing on the massage oil inventory?
I'm not sure. I haven't checked in a few days.
Wait, what? You haven't been keeping track?
No, I'm just the creative talent. I thought you were keeping track.
You know, nobody's perfect, except yours truly, of course. Inventory errors are going to happen. And when they do, it's your job as a bookkeeper to deal with it smoothly. Like cream cheese on a Berry White You'll Buy Everything bagel. But just like the number of calories in those bagels, inventory errors typically occur because something got miscalculated. Maybe a vendor doesn't send the correct amount of inventory. Maybe the owner counted wrong or had the wrong value. Either way, this mistake will mean that the inventory amount won't add up. A little bookkeeping joke for you. Now, from a bookkeeping standpoint, when an error happens, it has sort of a ripple effect that's going to mess with things like your net income and asset value. So your income statement and your balance sheet aren't going to be accurate. What do business owners love about the income statement? Seeing that beautiful net income in the black, hopefully. But in order to figure out that net income, they need to know the cost of goods sold. You see where I'm going with this? If you have errors in the beginning or ending inventory, miscounts, pricing issues, that sort of thing, then it's going to mess up your calculation of the cost of goods sold. If that happens, your income statement is going to get a little wonky. And I don't have to tell you what a pain that can be. Whew, so you see how much a simple miscalculation in inventory can affect your income statement? Just like miscalculating the calories of a bagel can affect your waistline. As if that wasn't enough, inventory errors can affect the balance sheet too. Remember this? Of course you do. You're a bookkeeping boss. We can use this equation to determine the impact inventory errors have on your balance sheet. Take a look here. If our ending inventory is overstated, then our assets and equity will also be overstated. The reverse is also true. If our ending inventory is understated, then you guessed it, our assets and equity are understated as well. Liabilities are untouched, like last week's leftovers. So, any mistake with our inventory impacts our income statement and the asset and equity calculations on our balance sheet. And if the balance sheet is off, then I know I don't have to tell you that something's off balance, do I? Look at me making another bookkeeping joke. Seriously, if this bookkeeping rescue thing doesn't work out, maybe I'll give stand-up a try. Now, the thing to remember about inventory errors is that they stick around for a while. Kind of like that bad haircut I had in college. Ugh, yeesh. Here, let me show you. First, let's say you did everything correct. In 2020, your business sold $80,000 worth of goods. Now, when you started the year, you had $20,000 in inventory and purchased $40,000 more, giving you $60,000 in cost of goods available. Now, at the end of the year, you counted up your inventory and found that you had $15,000 left as your ending inventory. Assuming everything else is correct, you would have net income of $25,000. Now, let's assume you made an error with the ending inventory and miscalculated the value of what's left and listed it as $12,000. Assuming that was the only error, that means that your incorrect net income would be $22,000, which means it's overstated by $3,000. But honey, we aren't done yet. Remember I said that little mistake carries over to the next year? Well, those ending inventory balances become your new beginning inventory. So when that little mistake of $12,000 gets factored in, you have a net income of $13,000. Whereas if you had entered it correctly, you would actually see a net income of $10,000. That means your net income is overstated this year by $3,000. Yikes! Paying taxes this year won't be fun. As a bookkeeper, chances are you'll be working with an accountant to fix inventory errors, but it's still good to know the process. Generally, there are 2 steps to correcting an inventory error. First, you'll need to create a reversing journal entry to correct the error and wipe it from the books. So let's say you incorrectly recorded a cash inventory purchase of $10,000 instead of $1,000. To fix that, all you need to do is create a reversing entry debiting cash and crediting inventory by $9,000. Boom! Problem solved, right? Wrong! Remember I said that inventory errors have a sort of ripple effect? Well, when you make changes to correct them, that means your financial reports aren't going to be accurate anymore. Because of that, the next thing you'll need to do is reproduce your corrected financial reports. While it's not necessarily a hard process, it is an important one. Here's a friend of mine with some tips about correcting inventory errors.
Okay, now we're going to talk about reversing a journal entry. The entry we're looking at right now was funding inventory. And basically, there's a key punch error. The inventory should have only been $1,000, not $10,000. So there's an extra zero in there. This particular journal entry is dated 12/31/20, and the books have already been closed for that period. We do not want to go and edit this journal entry. We want to create a reversing journal entry. So there's several ways to do it. If you are logged in as an accountant, there is a way to check a button and reverse the journal entry. But what I'm going to do is actually make a copy of this. So I'm hitting the more in the bottom of my journal entry. You'll see that menu anytime there's a saved transaction in QuickBooks Online. And I'm going to go ahead and copy this. Now I have made a copy of my journal entry with all the rows there. And you can imagine if this journal entry had 20 rows, this is going to save you a little bit of time. And basically, I need to reverse a portion of this. It should be for $1,000 net. So I need to reverse it by debiting $9,000 to inventory asset and then reducing cost of goods sold by crediting that by $9,000. So the net difference is going to be that $1,000. Also, that is not going to be in the prior close period. Let's go ahead and make that adjustment on the first of the following month, which this period in theory is not closed yet. So we can make those adjustments now. You can see it's already toggled to my next journal entry number. And now we are reversing the existing journal entry by creating a new one. I'll hit save and close, and that's reversing a journal entry.
I know it seems like a while ago, but remember when I talked about how bookkeepers need to be ethical and responsible? Well, this is one of those times. An inventory error might not be your fault. Heck, you might even be the bookkeeping boss that found it and saved the day by correcting it. Either way, when errors are fixed and new reports are created, it's important that you make sure to add a disclosure to those new financial reports, stating what was done and why. This way, anyone that looks at it will know what is going on and why there are new reports. Here, listen to an expert with some advice for you about disclosures.
When we find issues or errors, especially when it comes to specifically inventory, we want to make sure that we disclose that issue or error in a way that helps somebody who's looking at those reports to understand why there could have been a change for that same period. So you ran the financials for January, you gave those to the business owner, then you have an error that is discovered that affects that, and you redo those financials and give that to the owner. You want to help them understand what the differences are, why that change was made. Now, when we use the word disclosure, typically accounting professionals will think of disclosures as something very formal that you might give with a financial statement for a bank or an investor. This is a piece of information that could be used potentially in a disclosure, but those types of financials are going to be released by an accountant, and they go through a much more rigorous process and would want to have more explanations and so on and so forth. But what we want to do always as a bookkeeper is document changes, errors, issues that are going on in the books, especially if they are material, meaning that they're fairly large or could affect an amount or a number that somebody is looking on that report when they had previously looked at it and didn't see that change or that error or issue. So again, we want to have good notes all the time. Anytime we find things when we're working with a client that are going to be significant or important to highlight, we want to make sure that we disclose those. We tell, obviously, our owner, the business owner who is looking at those reports, but also potentially if we're working with an accountant that might be doing a more formal disclosure, we want to give them that information so that they can make the appropriate disclosures on those reports officially.
Well, ladies, it looks like you finally got all of your inventory issues in order. Nice work.
Yeah, it certainly took a while, but I think we have everything fixed and accounted for.
Look at you making a bookkeeping joke. I clearly have been making an impact on you both.
I'll say, but seriously, thank you. We'd still be knee-deep in inventory errors if it wasn't for you. Now we have a schedule of which of us is going to do an inventory count each day.
Well, that all sounds great. And you both have really started to make noticeable improvements with your bookkeeping skills. Just promise me that while I am still here, you'll keep me in the loop before you make any big decisions that are going to impact your finances, okay?
You got it.
Welcome back. In this lesson, you'll learn about liquid assets and fixed assets. Let's get started. Now, let's look a little closer at our balance sheet. If you remember, we talked about different types of assets in an earlier lesson. Let's do a quick review. Current assets and non-current assets. So now we know PP&E is a type of non-current asset. It gets listed on the balance sheet under, and I know this is a shocker, non-current assets. Examples of PP&E include vehicles such as company trucks, office furniture, machinery, buildings, and land. It's considered a big deal because when potential investors or analysts need to know how the company is spending money on fixed assets or ways to increase profits, they look at PP&E. So, it needs to be calculated and entered correctly. The value of PP&E is spread out over a number of years. Also, PP&E gradually loses value over time. When the item depreciates in value, that information has to be calculated, booked, and added to the proper financial statement for tax and accountability reasons. We'll get deeper into depreciation in a future lesson. For now, let's learn how to set up a PP&E, also known as a fixed asset account in QuickBooks.
So now let's talk about our business owner that has purchased an expensive piece of equipment. When we say expensive, we mean expensive. Let's say in this scenario, it's $120,000. And they're going to use that piece of equipment for a long time. Let's say it's a 10-year lifespan typically for that piece of equipment. Now, if the customer is going to do that, a lot of times they want to take that expense right away, of course, because that's a tax deduction. So they want to immediately do that. However, for a purchase that large, typically that is not something that is going to be immediately written off as an expense. It would be an asset. So let's go take a look and let me show you what I mean by that. So let's just go take a look at a balance sheet. If we were to look at this particular company's balance sheet here, you can see that they probably would have something here like a truck or a piece of equipment. It would be sitting on the balance sheet as an asset. In this case, it would be listed as a fixed asset because it is a really big piece of equipment that's going to be used for quite some time. So it's likely going to be listed that way. Now, that typically any type of capital purchase like that, especially something $120,000, would be listed as an asset. But each year they're going to be able to expense that out by using something called depreciation. And of course, each year that they record and each month that they record that depreciation, it accumulates and it is giving us an estimate of the value of that asset each month and year as its usefulness depletes. Now, we all know that there can be all types of things that come into play there. There can be a gain on that asset. It could become more valuable. There's lots of different things. We're just dealing with our accounting entries here though. So we would have the asset, the purchase price, and then the depreciation, the accumulated depreciation. Of course, accumulated depreciation is going to show here, you would see the asset, then you would see a reduction of the value of that asset each month and year that depreciation is expensed. And of course, where would that show? That would show on the profit and loss as an expense. Typically, it's going to show somewhat toward the bottom, usually around these other expenses, and it would be listed here as an expense on the business on the profit and loss statement. Now, one other thing to mention about this, what happens at tax time? Well, that depends. There's a lot of different tax rules that can go on, and you're not responsible for all of those. The biggest thing that we always want to do is make sure that when we record a transaction, if you're using QuickBooks Online, I like to have a picture of the purchase with that transaction so that we can see it and the accounting professional can also see it when time for tax preparation. But there are some special tax savings that happen for small businesses that are buying capital equipment. There's one type of deduction that's called a Section 125 deduction, and that would allow them to expense all of that in 1 year. So instead of saying $120,000 expense or purchase that was done, that they divide over 10 years to get the tax deduction, there are special incentives that are put into law through tax code that would allow them to expense that immediately and give them savings on their taxes right away. But again, that is something the tax professional is going to do. Our job is just to make sure that it's recorded properly. We're recording it like it needs to be, and that we have the information so that when asked, because they will ask for a purchase like that we have the information, and then we record the entries appropriately. Keep in mind that all tax savings like that special kind of deduction is not necessarily going to be reflected on the client's books. That could be done separately through the tax return, but wouldn't be changing that it's still an asset and has regular entries for accumulated depreciation, even if they have already fully depreciated it on the taxes. So you may just continue even though they've already received a full deduction for it. So all that to say, record the entry properly as an asset, depreciate it as instructed by the accounting professional who's providing that depreciation entry, and make sure you have all the information so you can provide that when requested.
Let's observe an expert set up a fixed asset account using QuickBooks.
So our organic farmer, Felicia, has decided to purchase a grain grinder and a cleaning machine. So those are two pieces of equipment that she's going to buy, and we are told that they should be added as fixed assets. So what I'm going to do for you now is add those two pieces of equipment to the chart of accounts, and I want to make sure they show up on the balance sheet in the fixed asset area. So I'm going to navigate over to the accounting menu in QuickBooks Online and go to the chart of accounts. All right, within here, we've got our assets near the top of the chart of accounts. I'm just going to scroll down a little bit. We do happen to have a truck on the books as a fixed asset, and it looks like it has its own depreciation and original cost sub accounts. I'm thinking we should have maybe equipment for the organic farmer, so we can call it shop equipment or something like that. And I'm going to add a new fixed asset account. So let's go ahead and do new and choose the correct type. Remember, type determines what financial statement it shows up on and also where it's ordered in the chart of accounts. Definitely fixed assets. And we're going to put, let's just say, other tools and equipment. And we're going to change the name. This will be the name actually on our financial statements. So I'm going to put shop equipment and save and close. Now within the fixed asset area, we now have computer equipment here, shop equipment here. I personally would add sub accounts under either of those so we can actually track depreciation and the original costs separately. So let me quickly do that for our shop equipment, and then we'll know where to book these once we purchase the equipment. The actual transaction for the purchase is going to fund it. So two more, I'm going to do depreciation and original costs. Again, same account, original cost, and we're going to call this one original cost. And it is actually a sub account of, and let's go to our shop equipment account. Oh, here it is, shop equipment, save and new. So I don't have to leave the screen. It'll pre-fill some of this for me. The only thing I'm going to change is accumulated depreciation. And it looks like on our chart of accounts, we have removed the accumulated part from these other accounts. So I want it to look similar. And I'll again make that part of shop equipment, save and close. And this is me looking at what the prior bookkeeper or accountant did. And I want to align my accounts to be similar to what the client is used to. Now, once the equipment is purchased, you would fund here. And once you start depreciating, you would use that account. And that's how you add accounts for fixed assets in QuickBooks Online.
There's one more thing worth mentioning. If there had been delivery fees or taxes for the equipment, you would add those to the purchase price of the asset. This total is called the original cost. You'll learn how to add it to the balance sheet in a future lesson. For now, let's see what you've learned so far. Great job! Just like everything else in accounting, you'll learn the more you practice, and all the concepts build on each other, kind of like a delicious wedding cake.
Okay, this makes sense, but I feel like there's more to this.
Yep, you're right, Sophia. Summer, you okay? Han?
Okay, Bianca, bring on the rest of the fixed assets cake. Oh, wait! Another fixed asset. The float tank is here. We can start offering float therapy.
Just when I thought I heard everything. Okay, well, you are correct. This expensive piece of equipment is a fixed asset and will need to depreciate it.
Depreciate it? No, I need you to appreciate it. This baby is going to bring in a whole new revenue stream for us.
Sophia, I do appreciate your smart investment decision, but I also need to depreciate it in accounting terms.
Whatever. I'm going to set it up right now and take a float.
This whole conversation is disrupting my yin and my yang. I need to go forest bathe.
Well, that escalated quickly. As you know, a fixed asset is booked differently from an expense. Let's break it down for the new float tank. All in, Summer and Sophia purchased their float tank for $12,000. We add this to the balance sheet as a non-current asset and create a sub-account, accumulated depreciation, a contra asset account. Float tanks have a service life of 6 years, after which corrosion from the salt water makes them inoperable. Think back to the matching principle you learned about in Bookkeeper Bootcamp. We want to recognize the expenses associated with the float tank as it provides its benefit to the business. We wouldn't want to record $12,000 in the first year that the float tank went into operation. This would mean all of its benefit is used up in 1 year, like a Pizzas of New York wall calendar, and that's not the case. Sometimes one person's trash is another person's treasure, like these exclusive Carlo P pumps. I snagged them at a resale store. Jealous? But I digress. Back to accounting. You might be able to sell your non-current asset for scrap or to a hobbyist. Who knows? The point is this is called salvage value. Here's a bit more info from our expert.
Salvage value is basically what the company's expecting to receive in exchange for an asset that's already been fully depreciated or at the end of its life cycle. So maybe they bought a piece of equipment, a forklift, and they're assuming it'll be in use for 7 years. They're going to depreciate it out for 7 years. On the books, it'll have a little bit less value every month. That'll be the book value as it's being depreciated down to zero. But the salvage value at the end of that 7 years, just because the book value is zero, doesn't mean they can't sell that forklift for $7,000 or $8,000 and get a little cash in. So even though the book value might be zero at the end of the depreciation cycle, salvage value, a forklift still has value.
So, where's my other little ray of sunshine this morning?
Meditating on the beach.
In my day, we called it sunbathing. What are you doing?
I think we're going to need another stationary table, but we can't afford it.
Is there an option to lease?
Yes, there is. I guess we just enter it like we did PP&E, right?
Listen, sweetie, I love you, but are you mocking me? They do not get added like PP&E. And anyway, there's a bit more to leases than that.
Was afraid you'd say that.
Looks like they might need to add an equipment lease to their books. Leases are another one of those transactions, like depreciation, that need journal entries. I get nervous, though, when I see clients trying to do that themselves. The beauty of software like QuickBooks is that entering transactions like receipts automatically fills out the journal entry for us. I've seen too many clients mess things up by trying to enter everything with the journal entry feature. There are a few special transactions, though, that need a manual journal entry to be created in the system, and an equipment lease is one of them. On top of that, there are two basic types of equipment leases, and we'll need to get you up to speed on both in order to help these two get the equipment they need. So, without further ado, let's dive right in. The most obvious way for a business to acquire the equipment it needs to run its business is through purchase. No shocker there, right? Well, another way for the business to get that equipment is through leasing. A lease is basically an agreement to pay rent for a specific period of time for the right to use an asset, in this case, a piece of equipment. In a lease agreement, the lessor is the party who owns the asset and is renting it out. The lessee is the party who is paying the rent to use the asset. There are basically two kinds of equipment leases, an operating lease and a capital or financing lease. The main difference to note between the two is the idea of transfer of ownership. In both cases, an asset is being rented. With an operating lease, there is no intention for ownership of the asset to transfer hands at the end of the lease. On the other hand, in a capital or financing lease, the option to take ownership of that asset is intended to transfer hands from the lessor to the lessee at the end of the lease. You think you got all that, Hotshot? Let's do some practice to make sure. This idea of ownership is super important to understanding the difference between an operating and a capital lease, and even affects how each is recognized on the books. With a capital lease, transfer of ownership to the lessee is the key criteria to determining whether or not the lease is a capital or operating lease. In addition, what we call the risks and benefits in the accounting biz are transferred to the lessee, meaning that the lessee will have to pay for stuff like taxes, maintenance, and insurance. Capital lease is considered an asset, so it will show up on the balance sheet. From a tax perspective, this all allows the lessee to claim things like depreciation on the asset itself. This is all different with an operating lease because ownership is retained by the lessor. The risks and benefits stay with the lessor. Because of this, payments are considered an operating expense and so show up on the profit and loss statement. For tax purposes, an operating lease is considered a rental expense. So, to break it down a little further, a capital lease records interest expense, keeps the originally booked asset and value on the books, does not record lease expense, while an operating lease reduces the value of the asset on the books, the right-of-use asset, records lease expense, does not record interest expense. Let's hear from an expert with some advice about the differences between operating and capital leases.
So capital versus operating leases. So 99 times out of 100, when we look at leases, typically with a small business, it's almost always an operating lease. This is going to be for a copier almost all the time, it feels like. And when they pay that lease, it is listed as an expense. 100% of that payment would go to a lease expense typically. Now, when we think of an organization having a larger piece of equipment, a bulldozer or whatever the case might be, where they're using it in the operations of their business, it could very well be a capital lease. With a capital lease, we're going to list that as an asset on the books. And it's almost like having a loan because the entire payment on that lease is not going to a lease expense. We would, in fact, need to break that up as interest expense on that payment. And that's the piece that would be expensed. But it is important to note that that can vary depending on the actual lease agreement. So typically what I would see with most bookkeepers is you might have a copy of that lease. You might read that lease and get your idea of what you think it is. But typically we're going to refer to the accountant and ask them exactly, what needs to be done. And then we would actually book that transaction according to how they direct us to do that. Again, always recommend reading that and having some idea and learning through that process. But typically we'll work with that accountant to decide how that's going to be recorded. And then going forward, we would record the payments as needed, whether it's a capital lease and we expense part of that as interest, or if it's going to be an operating lease where 100% of that payment would be listed as a lease expense.
So let's take a look at how this all affects setting up the journal entries. First, we'll cover operating leases. To record an operating lease, we'll need a journal entry to record the lease itself. We'll then need another journal entry to record the initial payment of the lease. We'll also need 2 journal entries to record the monthly operating lease payment. Notice that this first journal entry affects 3 accounts: lease expense, lease liability, and equipment operating lease. The second journal entry affects the lease liability and cash accounts. In this journal entry, we are adding the accrued interest to the lease liability account. All right, now let's take a look at the journal entries for a capital lease. The first entry is to record the capital lease. We'll then need another journal entry to record the initial payment for the capital lease. Finally, just like before, we'll need a journal entry to record the monthly capital lease payment itself. Notice that there's no lease expense account here. Payments are recorded similar to standard liabilities. One payment split into interest and principal. I know it seems like a lot to throw at you, but the structure is the same for both. Record the lease, record the initial payment, and then record the monthly payment. To put this into perspective, let's hear from one of our experts.
I worked with, there's 2 different things here, right? One, I've worked with a medical supply company, and when they made an agreement with the equipment that the doctors would buy, there were times that the doctors would not hold up their end of the bargain, whether they lost business and they couldn't keep paying. But my employer would go and they would take the equipment back. And so, that's a tough situation. But it really is something that, if they're not keeping their part of the bargain, then they can't keep it, right? They had huge equipment. And so it was just something that if they weren't able to make the payments, they got it taken away. So yeah, that was a tough thing. But, then my employer was then able to then sell it to somebody else and then utilize, move on and take that equipment to another doctor or chiropractor, depending on what the equipment was.
Like depreciation, equipment leases are an instance where you would need to manually enter your journal entries into QuickBooks. We would do this following the same path as we did to record the acquisition of the salt tank. Let's take a look at manually entering a capital lease into QuickBooks. For a capital lease, we need 3 journal entries: 1 for recording the lease, 1 for recording the initial payment, and 1 for recording the monthly payments. Let's say that Sophia and Summer wanted to add a stationery table. They're pretty expensive though, so they decided to lease one. You're going to practice entering the transaction yourself. But before you do that, let's get some help from one of our experts.
Let's demonstrate entering a capital lease onto the books. Basically, a capital lease means the equipment or whatever it is being leased. However, it is tracked a bit differently on the books. It's more like a purchase. Basically, we're setting up a fixed asset, we're going to depreciate that, and we're also going to make payments on it and possibly have interest expense as well. A capital lease will need to be determined by the accountant, but in theory, if somebody is going to purchase the equipment at the end of the lease, that could be considered a capital lease, and you might want to have that conversation with the CPA or accountant or whoever's managing that end of the accounting. Okay, so let's go ahead and set that up. I'm going to go over to the chart of accounts. And this company is going to put in a lot of effort into getting their computers and their back office secure and correct. And they've decided to go into a lease on a server and a bunch of desktop computers and a remote access to the company. So it's a big purchase. However, they're leasing it, and they may or may not buy that equipment at the end of the lease. So you've been told it's a capital lease. So we are going to set that up very much like something they've purchased, which is a fixed asset. And we're going to put that to computer equipment. So this is the parent account. I'm going to go ahead and add this. So again, it's like a fixed asset, even though they're just leasing it. All right, there's our first account. And then what we're going to do is because it's the way it's structured, we will be able to put in the original purchase. Well, it's not really a purchase, the original payment. And then on top of that, depreciate that as well. So let's go ahead and add some more account. And we're going to do another fixed asset. Again, it's computers. This will be a sub account, computer capital lease. And I'm going to do one more, accumulated depreciation. So let's do fixed asset. And this one is depreciation. And again, on this company, we don't put the word accumulated on the chart of accounts, which is okay. Computer capital lease. All right, so now we have the structure on the chart of accounts where we can go ahead and start entering things. So now we'll do a journal entry. Let's say they spent $10,000 as the original payment on this capital lease. So I'm going to go ahead and do a journal entry representing that. And I'm going to put in original, well, let's put in the checking account. Let's take the money out of the bank first. Checking account. And we're going to credit that for $10,000. And then we're going to go to our original payment account on the capital lease and debit that by the $10,000. And that's reducing the bank account because we wrote a check or whatever this journal entry is representing. And then that's going to post to the balance sheet showing funding of that lease, the initial payment. And here it is there. And again, sub accounts always total in the parent account here. Okay, so the next one is maybe we'd have to make a payment on this capital lease. So month by month, you could write a check or whatever it is. It might be interest and principal come into play here. So let's go ahead and do a new journal entry. In this case, it's the following month. February 1st, we're making our second payment. Let's say it's $4,500 a month for this equipment, and that'll come out of the checking account. And then we're going to debit the lease for, and I'll go to the original payment, and we're going to do, let's say, $3,000 of that is for the actual lease, and then we've got interest expense. We don't have interest expense yet. I'm going to go ahead and add it on the fly. Interest expense. And this allows me to add to the chart of accounts as I'm working. I don't have to stop my work. And let's see if we can find interest on here. Interest paid, save and close. So the balance of $1,500 is the interest represented here. And now the $4,500 is coming out of the bank. Part of it's going to the lease, part of it's going to interest. And that is how the monthly entries would be done. And you could also depreciate that. So again, your accountant might be making the determination on how frequently to enter that depreciation and how much. So based on their instructions, we are going to depreciate this at the end of each month. So I'll start with January. And we're going to do depreciation on the computer. You can see it's kind of showing me that this is the sub account of the computer capital lease. We're going to go ahead and depreciate that, oh, let's say $200 a month. And again, go to the accountant to get that number. Don't just make up numbers, okay? And we're going to put that to depreciation expense. And again, this is the month of January. We've depreciated this. They've told us to do this every month. So this would be something that you would enter monthly or use the QuickBooks feature to make it recurring and have it post automatically for you. So that is how you enter the depreciation on the capital lease. I'm going to hit save and close. And hopefully that is helpful and the explanation is clear. Thanks.
This is great, Bianca. You know, I really think this is doable.
Glad to hear that, sweetie. Now don't go renting popcorn machines and all that.
Believe me, I think we've got enough work on our hands as it is.
Hey, there's my little ray of sunshine. Feeling refreshed now?
Yes, I'm feeling quite rebalanced.
Bianca, we can't thank you enough for all your help. If we'd have tried to do this ourselves, it would have been...
a hot mess?
Yeah, you said it. You deserve a break for all your help. Why don't you take a dip in the salt tank?
Sorry, ladies. I'll have to take a rain check on that. I have another boot camp I have to get to.
More job application rejections? My mama always told me you gotta fertilize your soil before you plant your seeds.
What the heck does that mean?
It means you skipped some steps in your job search, and if you don't go back and do them, well, you're not getting many jobs.
Oh.
Go ahead in your job search to land those interviews. With our free guide, How to Get Interviews, you'll be harvesting job offers in no time.
Thanks, invisible voice of reason. I have 3 interviews.
Click below to learn more.
Welcome back, everyone. Are you ready for another installation of Bianca's Bookkeeping Bootcamp? I know you are. Time to top up your bossness by practicing what you have learned in the last week. Remember, practice makes perfect. And also remember, always give 100% at what you do. Unless you're giving blood. You're a great crowd. Okay, let's get right into it. Let's get back to Cindy and her amazing party palace, shall we? With the recent sales, Cindy can now pay off some of her liability to Bob's Elegant Emporium. She pays $3,000 of what she owes, bringing her liabilities, or her debt in this case, down to $2,000. Amazing! You've got this! Hey, did you notice that if we were to make an error early on, it would have an effect on the rest of the accounting equation for each transaction? Timothy's Twinkle Time Cleaners books would have been a mess. So, like we've mentioned before, it's really important to set things straight as soon as possible if you spot an error. One thing the accounting equation is helpful with is spotting errors. If things are not balanced between the equation, you have to have a look around to see where the error may be. Let me send you over to an expert who can fill you in on errors related to sales and some common corrections. I'll just be over here, still thinking about pie.
As we all make mistakes, right? Not anyone is perfect. Thankfully, we can all understand that we make mistakes. And, it could be a simple mistake, right? You receive $150 and you accidentally put it in as 200. Somehow you counted it wrong and you actually entered 200 instead of 150. And so now your accounts receivable is all off and things are all incorrect. And your income is overstated. So the place to look, you can look at the balance sheet, you can look at the income statement, you can look at the profit and loss. But a lot of times as bookkeepers, we need to depend on our clients to help guide and direct us when there is a mistake. And they notice that whether we made the mistake or they did, So, you can look at that and you can see that you would have made an error. So you may have done a $200 debit to cash when you entered in that money that came in, and a $200 credit to receivables instead of what was correct of $150 for both of those. So, you can correct it by finding the difference. This is simple, right? 200 minus 150 means that we have $50 that we need to account for, and find that and correct that amount. So we would take that $50 debit to cash, and then the $50 to a credit to accounts receivable. So, and as you're looking, you can see the change that happens on the balance sheet, on the income statement, and it all reflects what you've done as the change. So for correcting errors, you really need to make sure that you understand what you need to be crediting and debiting, because if you go in the wrong way, you can make a really big mistake, and there can be a really big error on their statements. So we want to make sure that we take our time, that there's enough thought that goes through, and even consult with somebody else. If you're not sure, don't just make that error and just think I'll fix it if I did make an error. Don't try to do it on your own. You can. It's okay to ask questions. The question that's not okay is the one that you don't ask.
My friends know everything, don't they? Just as an aside, accounting software today has the fundamental accounting equation built into the application. What does that mean? It means you are in luck. That's what it means. Because while it is important to understand the equation and its impact on your financial statement, the software will reject any entry that does not follow the principles of the equation. But don't forget, luck favors the prepared. Well, that's it. You have conquered the accounting equation as it applies to sales, like a boss. Next up, we're going to apply the accounting equation to inventory. Inventory, like shoes and home decor and things. I never stop, do I? I can't help it. I'm a shopaholic on the road to recovery. Just kidding. I'm actually on the road to the outlet store. See you next time. And we're back. Nice work conquering cash sales and invoices last session. Up next, we're going to take you from Inventory Basic to Inventory Boss. Let's take what you know about accounting for inventory and apply it to the accounting equation, boot camp style. I'm like your accounting drill sergeant. Get down to business and give me 10 balanced accounting equations. You've got this, soldier. Oh, you're back. We have a saying here at Bianca's Bookkeeping Bootcamp. If boot campers keep learning, eventually they'll be earning. You've been putting in a lot of work here at the bootcamp. This is the part where you get to show what you know. As you learned before, plant, property, and equipment, or PP&E, can have a big impact on financial statements and even taxes if they aren't accounted for in the right way. So, for this part of the bootcamp, you're going to help a business account for the purchase and disposal of different types of PP&E. Before we meet the business owner you'll be working with, let's do a little refresher on PP&E. Let's meet Nikki Bell, the business owner you'll be working with.
Some of my best employees would be people that just need another chance. Someone that probably couldn't get a job. They'd had a record. They had baby daddy trauma. And I want to be that place where a girl can get a second chance. I did TV sales for years. Loved the money. But there came to be a part of me that felt like I was selling out every day. And I started to think, well, if you could do anything in the world, what would it be? You love cleaning your own house, why don't you start cleaning house? But in doing so, I'm still me, and so that meant that I had to be a domestic diva. And it's up to the diva standard. That's how it started. I started using TurboTax when I moved in this house 11 years ago. Because I was using TurboTax when I started my business, I was like, oh, get QuickBooks. That's the one that I use pretty much daily. They make me look bigger than what I am. My invoices are pretty with my little leave the dust to us. We're gonna go pass them out. And so, yes, again. There have been times, well, you can go get a job. I don't really want to go get a job. There are girls out there that really kind of need what I have to offer, which sometimes is wisdom and motherly advice. It's almost like a ministry to me, because the money will come. There are girls that need to know that you can do better in life. You can make a change. You don't have to keep going down the wrong road. You can start over. And I like to be the place where they can get a chance to do over here with me at Domestic Divas.
That Nikki is such a great woman. She got a new big contract and she needs to buy some equipment. Before you help her account for this PP&E, I have a friend who's going to walk you through an example in QuickBooks Online. Take notes if you need to, and remember, you can watch it as many times as you want.
So in our next demo, this company has purchased 2 large pieces of equipment. They received a large either capital investment or got an equipment loan somehow, and they have the cash in the bank to purchase these 2 assets. The first one is a mobile shredder truck for $750,000. On top of that, there was a delivery fee and sales tax. So we need to get that entered. And then we also have a stationary shredder that was also purchased for $35,000. And again, taxes, delivery fees, how do we account for all that? We're going to use a journal entry to remove the money from the bank or the checking account. Maybe there was a wire transfer or something like that. And then we will fund the value of these assets and show you how to enter all the delivery and everything else. So I'm going to go to the journal entry feature in QuickBooks Online by clicking plus new and journal entry. All right, these pieces of equipment were purchased on February 28th. The first thing that happened is money came out of the checking account. So I'm going to put in checking. And the money out for this first piece of equipment is $750,000 for the initial, for the asset itself, and that's the mobile truck. I'm going to hit the plus sign and do a formula right in this field. I'm going to add $5,000 for the delivery plus $1,500 for sales tax. So the total for that particular vehicle, the shredder vehicle, is $756,500. So that's money coming out of the bank account. Now we're going to account for the actual, you know, where's it going? Where's the money going? Well, we purchased a shredder truck and we have that on the chart of accounts already. And this is the original purchase. So you can see it's a sub account under the mobile shredder truck. So I'm going to choose that in there as a debit. Now I'm also going to capitalize the sales tax portion of this. So I'm going to put the original purchase of the stationary mobile shredder truck. There it is. You see how you can type in QuickBooks Online and it does a nice little search. So this is the correct one, original purchase. I'm going to capitalize the $1,500 of sales tax. And then I am going to write off, we do not. So I'm going to go ahead and add it. Again, you can add things on the fly while you're working. Don't have to leave here and go to the chart of accounts. I'm going to add an expense. And I'm just going to put this to other because I don't have a delivery detail type here. So delivery expense, save and close that. And this is the delivery charge. So now I basically have to duplicate that same process for the stationary shredder that we also purchased. So same idea. This was a different transaction coming out of the bank, but it was the same day. So I'm okay putting it in on February 28th. So first of all, the checking account. What did we pay here? Well, it was $35,000 plus, and I'm using the plus sign right on my keyboard, $500 for delivery plus $700 for sales tax. And I'm hitting tab to do the calculation. So this is stationary shredder. And then let's split this out. First of all, I'm going to do the shredder itself. So I'm going to just start typing stationary shredder and go on to the original purchase. There it is. So again, $35,000 for that. Then I'm going to go to the same account, stationary shredder. There we go. Stationary shredder, original purchase, and we're going to do the $700 in taxes, capitalize that as part of the asset, and then delivery charge. And that was $500. Here, I'm going to change this to sales tax and change this description to delivery charge. I always like to put descriptions in as if somebody else who has never seen these books before will know exactly what this is. So in 5 years, if somebody's looking at these books, they have absolutely every bit of information they need to decipher what this journal entry was all about. I would also have probably attached the purchase agreement or something like that. So you have backup for this as well. So again, I decided to write off delivery expense. The accountant may have wanted you to write off sales tax. Completely up to the accountant giving the instruction here. It's okay to ask. So I capitalized it, but it could be that the accountant might be asking for something else. That is basically how to get that original purchase of these two pieces of equipment in here. In this next demonstration, we're going to show you how to dispose of a fixed asset. A fixed asset might be disposed of when it is sold, maybe, or maybe you've fully depreciated it and it has no value any longer, and maybe you even donated it to somebody. So let's show you how to get that done. We're going to go and get rid of the two pieces of equipment we purchased earlier. One was a mobile shredder truck, and the other was a stationary shredder. And we've jumped forward 5 years, and we are about to dispose of both of these in two different manners. So just to remind you, on the chart of accounts, under fixed assets, we have both of these assets listed. Under shredder equipment, we have the mobile shredder truck. And over the past 5 years, we had originally purchased it for $751,000. It's about halfway through being depreciated. And the net value, which shows up in the parent account here, is the $375,750. We are going to sell this asset. And guess what? Somebody's going to pay the company $400,000 for this. So what we need to do is wipe out the value of this asset because it's being sold, and we're actually going to get a profit on that. The second thing we're going to do is the stationary shredder. The stationary shredder has been fully depreciated, and it's been donated to a nonprofit. It no longer belongs to this company, and we're going to go ahead and wipe this off the books because we don't want it showing up here on the balance sheet any longer, or chart of accounts for that matter. Okay, so let's start with the somebody buying the mobile shredder truck. Okay, actually, I'm going to copy this value here. So that's the value of my asset. So I want to make sure I remember that. So I did a Control-C there to copy that. And I'm going to go to a journal entry. So this first journal entry is representing the sale of the mobile shredder truck. We received a check for $400,000. And deposited that to the checking account. There's my $400,000 going in the bank in sale of mobile shredder truck. And hopefully I spelled that right. Okay. Now we need to offset the original entries, which is the purchase of the, or the remaining value of the asset itself. So I'm going to quickly jump over. I'm going to duplicate this tab because what I want to do is actually look at my values that are on the chart of accounts. If you right click anywhere in QuickBooks, you can duplicate a tab and open QuickBooks again, which is kind of nice. So what I'm going to do is go to my chart of accounts and look at my values for the mobile shredder truck. So that way I don't have to leave my work, the journal entry I'm working on. All right, so back to the chart of accounts. We're looking here. The original purchase of the truck was $751,500. So I'm copying that. And I originally had debited for that purchase. So I'm going to credit that to mobile shredder truck, original purchase, and that's the value. So I'm going to wipe out that initial value. And then I'm going to type in mobile shredder truck again, and the depreciation value needs to be entered here as a debit. So let's go ahead and look at what my depreciation value is. It's right here. And I'm just Control C, copying that, going back to my journal entry and pasting it in there. So that's wiping out the depreciation that's been accumulating over the life of this particular asset. And then finally, there is a profit here. We are selling it for $400,000, but the value on the books is only $375,750. So there's a profit to the company. So I've set up another expense account called Proceeds from Sale of Equipment. They basically made a profit of $24,250 on this equipment after all their expenses and using it for years. That's kind of pretty good. So that is how we write that off and get it off the books if there was a sale. Obviously, if they had a loss when they sold it, it would be the opposite. It would be a loss from sale of equipment. It would be an other expense account. But I'm going to hit save and close because I want to show you the chart of accounts and see if we've updated our values. Always good to double check your work, right? So everything has zeroed out for the mobile shredder truck. It has not removed the historical activity. It's just zeroed out, and now I can make these accounts inactive because they no longer, this truck no longer belongs to the company. The next one we want to deal with is this stationary shredder. This has been fully depreciated. It was purchased for $35,700, depreciated over the last 5 years. We need to just get this off the books as well. So let's do another journal entry to clear that out. So let's go to journal entry, and this was fully depreciated at January 1st or 31st of 2026. And now we're going to do stationary original purchase. It was a debit originally, and again, back to my chart of accounts, $35,700. Copy that, paste it in my credit. Donated stationary shredder. So maybe we donated it to a nonprofit or something. And then this would be the accumulated depreciation, stationary depreciation, and it's the offsetting entry. Again, back to the chart of accounts. This was a debit, this was a credit on the original entries. And now I'm just reversing that. This is now a credit and this is a debit. So again, save and close, always double check your work because you can always go back and fix it if you need to. So scrolling down, and now all of these assets should have zero value. And that's what we want. You don't want to make an account that it is a balance sheet account inactive in QuickBooks Online, because if you don't zero this out, QuickBooks Online will for you, and it does a journal entry to and it offsets to opening balance equity. We don't want to do that. We want to fully remove these assets the way they're supposed to be done and then make them inactive after they're zeroed out. And that's how to liquidate your assets, either by selling those assets or donating them or just retiring them. In this lesson, we are going to demonstrate how to book a capital lease versus an operating lease. First, let's focus on the capital lease. We have leased 2 hard drive destruction machines from DriveThru. So we need to get those on the balance sheet actually as a fixed asset, because capital leases are booked very similar to a purchase of equipment. Let's add the 2 fixed asset accounts that will track the value of our 2 hard drive destruction machines. So the first thing I'm going to do is click New on the chart of accounts, and we are going to choose fixed asset, and the detailed type is tools and equipment, and I'm going to name this one hard drive destruction number 1, and helps if you spell it right, but that's what this is for. Okay, and you know what, I'm going to copy that because I'm going to do another fixed asset account to represent the next one. So save and new. Let's do another one. In this case, this is the new screen. I've actually not saved this, and I'm going to just paste that in and change the number and save and close. So let's get back out to the chart of accounts and look for our fixed assets area. And here are my 2 hard drive destruction fixed assets. I like to look at the chart of accounts the way the client has it set up now and see if I would change anything. And you can see here the truck has actually different structure here. They have a truck and then the sub accounts. So what I want to do is put shredders as my parent account and put these 2 hard drive destruction machines underneath that. So let me go ahead and add a new fixed asset account to work as that parent account. And what that does is help total all of these all this shredding equipment together. And I'm going to save that. I'll go back and edit my 2 pieces of equipment. And I'm going to make this a sub of shredders. Started typing it, brought it up. And let's go fix the second one. Edit this one. Sub account of shredders. So now I'm tracking those together. What's nice about this is on the balance sheet, I'll be able to get a total for both shredders and their value. So it's kind of allowing me to have subtotals on that balance sheet. Okay, so that's the value of it. But when you do a capital lease, you actually have to offset the lease itself to a liability account. So what I'm going to do is set up a shredder capital lease liability. So I'm going to go back up to the top. And in this case, it is a long-term liability, and we'll leave that as notes payable, and I'll do shredder capital lease liability. And I will save and close that. And now I have a liability account to offset the value of the leases too. Next step is to journal entry the value of these 2 machines that we are leasing. And I am going to go ahead and do a journal entry to represent that right here. So each one, according to the contract, has a value of $11,250. So I'm going to type in HD and bring in my very first shredder, debit that for 11250. For hard drive shredder. Okay, and then the next one, I could type it in or scroll down. I prefer just typing it in, and the same value, same lease value, and that is my debit column. The credit would go to my shredder capital lease liability account. So again, debits equal credits. I can't save it unless they do. Let me save and close that for you. We'll go back to our chart of accounts, take a look at the value of our shredders. 2 shredders, each individually $11,250. Total value of both shredders we are leasing is $22,500. If I scroll down a little bit to my long-term liabilities, here's my shredder liability. And as we make payments on this lease, this liability will start reducing out. Okay, so that is a capital lease. Again, it is more like purchasing in a way. It's booked almost identically the same. With an operating lease, it's completely different. We don't even have to worry about the balance sheet at all, except for the fact that maybe cash is leaving the bank and it's going to lease expense. This one's really simple. I'm just going to go ahead and do a journal entry. I already have a bank account and I already have lease expense. So let's go do that journal entry. Let's say our first payment on the next lease is coming out of the checking account. And this lease is actually for a baler that will bale paper. And the lease is for $115,000 and it's going to go over 12 months. So basically what we're going to do is divide the 115 by 12. It could be on the contract that there might be some interest involved in there. So make sure you do look at the contract and see if there's any interest expense as well. So let's go ahead and we're going to credit the checking account. What I'm going to do is use a formula right here in QuickBooks Online, 115,000, and I'm hitting the backslash for divide, divided by 12. So that is what I'm assuming right now is the monthly lease. This would be without interest. If there's interest involved, obviously this payment is going to be a little bit more. We're going to credit the checking account and then debit lease equipment, rent or lease. So this is an expense account, as you can see on the profit and loss statement. And we're just going to write that off. Double check that there's no interest involved. If this payment is for more than that, then it probably is. And you want to maybe do a second row here for the interest expense as well. That is basically how to do an operational lease. You don't have to set anything up really, just lease expense and have the money come out of the bank account.
Amazing. You did such a great job. I think I'm going to have to reward myself with a brand new handbag in your honor. Am I right? Speaking of rewards, yours is knowing how to account for, depreciate, and dispose of PP&E, and how to book operating and capital leases. No small feat, my friend. Now you get a new challenge, showing even more of what you know in a case study. Remember, I've got your back, always.